If you own a business, you already have a massive equity-like risk in your portfolio, whether you acknowledge it or not.
If you are, let's say, exposed to a country where you live and work and you're employed there, then you may want to not save all your funds in that country currency. Lately, we've been hearing that the 60/40 split portfolio is dead. Can you break this down for us?
Hi Johanna, thank you for having me. It is about if 60/40 was ever really about the numbers or whether it was about a job those numbers were supposed to do for you.
And what happens if, let's say, one of those jobs, for example, downside protection from bonds, if that stopped working?
So today we are going to walk through how we think about asset allocation in 2026. And we'll talk about 60/40, 60/30/10, 50/30/20, and where the private credit fits into this equation. And probably the most underappreciated point in this whole conversation, why your life situation matters more than your age. And this is coming back to your question, why it's not working or working. It depends who you ask.
So let's start then with the first principle. When someone says 60/40, what are they actually buying?
Mechanically, 60% stocks, 40% bonds, but a better way to think about it is by the job description. Stocks are going the growth work. That's the engine of the growth. Bonds are supposed to be doing two things, providing liquidity and providing duration protection. In other words, when equities sell off in a recession, bonds are meant to rally and cushion the blow. Historically, that has worked. The framework is transparent, it's cheap to implement, it's easy to rebalance, and for decades, when equities had a bad year, bonds tended to have a good one. That negative correlation is what made 60/40 feel almost magical. But as you pointing out, somehow, somewhere it break.
What happened? Why is the correlation different now?
Because the correlation broke down, most painfully in 2022, when the stocks and bonds both fell at the same time and the cushion just wasn't there. BlackRock has made this point repeatedly that since 2020, bonds have frequently failed to hedge against equity sell-offs. So 60/40 didn't really die, but one of the jobs it was meant to do became less reliable.
Is 60/40 dead or incomplete?
Incomplete, I would say. That's the honest answer. 60/40 is useful starting point. It's not the whole conversation anymore. Too many jobs into too few sleeves. Modern portfolio thinking pulls them apart. I would argue investors should four separate buckets: the growth, liquidity, duration, protection, and contractual income. So growth, that's our usual equities. Liquidity, that's your cash and short duration bonds, the stuff you can sell in 5 minutes without worrying about valuation. Duration protection, that's high quality public bonds, the assets that should rally if a growth of the stocks disappoints you. And contractual income, that's loans, structured credit, certain real estate debt strategies. Things where someone is contractually obligated to pay you a coupon.
I see. And the issue then with the 60/40 is that bonds were trying to do two of those jobs at once. They were trying to provide liquidity and duration protection. And that was not really what they were designed to do.
Exactly, that's where the conversation about alternatives and particularly private credit enters into the equation.
So there are basically three frameworks people talk about. It's 60/40, it's 60/30/10, and last but not least, 50/30/20. Can you talk us through these?
So let's start with the classics. 60/40, 60% stocks, 40% public bonds, simple, transparent, liquid, cheap. The weaknesses of this is heavy equity dependence, especially lately on just a handful of stocks. And the bond sleeves carries the duration and inflation risk that we have now seen play out painfully in the markets.
And then the 60/30/10. What about that?
Still 60% stocks, but now you trim public bonds to 30% and you carve out 10% for alternatives. This is probably the cleanest, most realistic evolution of the 60/40 for most professional investors. It keeps the growth engine, it keeps meaningful liquidity, and it introduces diversification and contractual income through the alternative sleeves.
So what do you put then inside the 10%?
It depends, but a reasonable structure might be 4 to 7% private credit, 1 to 3% real estate, 1 to 3% liquid alternatives. But a critical caution, and I want to underline this, don't take the entire alternative sleeve and put it into one platform, even if I wish you put it to Kilde. One borrower, one geography, or one strategy, that's how investors sometimes get hurt.
Understood. Can I ask you a question on the 1 to 3% in real assets or real estate? Because realistically, a lot of people probably don't have portfolio big enough where you can buy, let's say, a piece of real estate for just 1% of your whole portfolio. Do you go to REITs or what are the options?
Yeah, REITs or fractional ownership, there are many ways you can nowadays invest into real estate or to have some fund, ETF, into the real estate.
Okay. And the last portfolio, the 50-30-20, I am guessing now where we're heading, that 20 is alternatives. Is that what it would look like?
That's right. Public equity is 50%, public fixed income 30%, alternatives 20. And it's where BlackRock is pointing that they have argued that traditional 60/40 is now too exposed to equity beta and bond duration, and that a modernized framework should allocate more to alternatives.
And this last portfolio with 20% allocation to alternatives, who is the right investor for that allocation?
Honestly, not for a retail investor. It's for sophisticated investors, high net worth individuals, people with long horizon and meaningful liquidity reserves. 50/30/20 is not a retail kind of thing, it's a liquidity budget decision. If you can't tolerate having 20% of your portfolio that you genuinely cannot sell tomorrow, next week, maybe even in a month, you shouldn't be there invested into those alternatives.
And bonds still play a role. They're not dead, even in this version of a portfolio.
Yeah, far from it. Vanguard in 2025 in their multi-asset outlook made the point that starting yield matters, and at current yields, bonds offer much better long-term expected returns than they did 3 or 4 years ago. Public fixed income is back as a meaningful portfolio role. None of these frameworks abandon the bonds. They just stop asking bonds to do everything for you.
Now, applying this into real life scenarios, let's say I am 33 years old and I'm looking to build a portfolio, and we have someone else who's 60 years old looking to build their portfolio. Who should own what?
So age is a proxy, and it's a proxy for a time horizon, but it's a very crude proxy. There are 6 or 7 variables that matter much more than the birthday on your passport or ID card, and it is probably who you are and in which stage of life you are.
Can we have the 6 variables, please?
Oh, it's a income stability is the first. Are you on a regular paycheck, or does your paycheck swing with bonuses or commission as usually with the salespeople? Upcoming cash needs, do I need to buy a house, do I need to buy a car, is a tuition bill coming, business buyout coming? What is my debt level, how am I leveraged already, do I have a mortgage? Wealth concentration, and this one matters enormously. If you own a business, you already have a massive equity-like risk in your portfolio, whether you acknowledge it or not. And retirement income. Do you have a pension income that gives you flexibility, or are you relying entirely on your investment portfolio to do the retirement income for you? And finally, the behavioral tolerance. Can you actually survive a 30% drawdown without selling at the bottom and panicking?
So that's very interesting what you just said. Let's take an example. We have 2 investors. They're both 40 years old. One has their own business, and to your point, a lot of equity risk in their own business. And the other one is a salaried employee with less equity risk. What's the difference in these 2 individuals' portfolios?
Sure, let's start with the salaried employee. Salaried professional, dual income household, mortgage already paid down to half, 2 kids in public school, stable pension contributions, and the other one, let's say, is a founder, net worth heavily concentrated in equity, in her own company, variable income, no pension, plans to sell the business in 7 years. Right? Completely different portfolios. Investor 1 can probably tolerate 70 to 75% of equities, modest alternatives. Investor 2, who is a founder and business owner, and it's very counterintuitive, actually needs a way more conservative liquid portfolio because her wealth is already overwhelmingly exposed to one private equity position, her own company. And the last thing she needs is another concentrated, illiquid bet.
Interesting. I've also been given advice in the past for expats specifically. If you are, let's say, exposed to a country where you live and work and you're employed there, then you may want to not save all your funds in that country currency if you're planning to relocate or retire somewhere else. It's a very good point. It ties into what you currently sit on and how you can hedge your bets in a way against what you're overexposed to.
Definitely.
So this gives us a little bit of a map by life stage. If you're younger, you have more time to accumulate. You can afford a little bit more risk, so then heavier on the equities. If you're a family with a mortgage, let's say, then you go a little bit lower on the equities because you cannot afford such a big dip, perhaps, in your net worth. And a peak earner or an HNI, to your point, they could maybe even do a 50-30-20 portfolio.
That's right. That's right. And the question might be where the private credit kind of fits into this context. So for the young accumulator, it might be 0 to 5%. For the peak earning high net worth individual, it might be 7 to 12%. For the retiree, often back down to 0 or to 5%. Not because private credit is good or bad, but because the job it does fit some life stages better than others, and some private credit instruments work better than others.
If we narrow down specifically on private credit, what should you be looking at?
In the private credit, you should be looking at the liquidity. You should be looking at the yield is depending on the interest rate curve, and you should be looking at the reliability of the platform you're investing through or the manager in the private credit, and what fees are you paying.
What are some of the common mistakes that you've seen people do when they select an alternative asset such as private credit?
Not looking at the term sheet regarding the liquidity. There's a number of mistakes, and it's played out not so well in the US recently. And secondly, they should look at the fees, how much they are paying, right? And what is the actual then net yield they are getting after all these fees. And they should understand, is it really a contractual income that the coupon they are getting is fixed, as in the matter of Kilde, or it is an income which is dependent on the overall interest rate. And then it started behaving a bit more like the bond, right? The point of it is a bit diminished in a sense in your portfolio, because then suddenly your income going to drop as the interest rate is going to drop, but you still have the illiquidity risk.
And we already know it's a sizable asset class, private credit. But what about current performance? If you're an investor and you read headlines saying this asset class is not doing well or this asset class is doing really well, should that impact your allocation decision?
Well, it's like global weather or the average temperature of all the patients in the hospital. For instance, JP Morgan in 2026, they made a review of the private credit, and they haven't seen a major deterioration in the credit quality in the fourth quarter 2025. Approximate default rates are around 2%. Yields are meaningfully above public high yield bonds, but they've also flagged concern that increased use of payment in kind, signs of borrower stress in a certain segments, and a tendency for investors to misunderstand what semi-liquid actually means. But those problems are usually isolated in the US, which is the largest private credit market. Us sitting in Asia, maybe you don't need to worry about it as much.
Before we close on this conversation, let's give listeners something practical. Before you add private credit to your portfolio, what should you ask?
You should ask 8 questions. Number 1, do I have emergency liquidity outside this allocation for my personal needs? 2, can I genuinely tolerate the illiquidity, or I'm going to panic in 12 months, right? 3, am I diversified across managers, sectors, borrowers, geographies? Number 4, who underwrites the loans and how good is their track record through the whole credit cycle? Number 5, what's the collateral and what does my downside look like if the borrowers stop paying? Number 6, what are the redemption terms, and do I understand that semi-liquid is not the same as liquid? And number 7, what are the fees? Because of the fees eat the illiquidity premium. And the 8, it is the most important one which most of the investors skip. What role is this investment playing in my portfolio?
Every allocation needs a purpose.
Every allocation needs a purpose, and if you can't answer that question, you are not making an investment decision. You are just collecting like different investment products.
If there's one message to take away from today, what would that be?
That conversation has moved from 60/40 is dead to a more useful question: what job is each part of my portfolio doing, and is there some sleeve missing? For many investors, the natural evolution from 60/40 is towards 60/30/10, and for more sophisticated investors with genuine liquidity capacity, towards 50/30/20. Private credit can complement bonds, but it performs a different portfolio function, and different assets solve a different problem.
Oh, super. Very insightful. We appreciate that. Thank you, Radek.
You are welcome.